Disclaimer.
Look at your screen. Today, Monday, February 2nd, 2026, silver is at $72 and gold is sliding under 4,500. But that isn't the biggest shock of the day. Right now, on the other side of the world, the Chinese platform Jiwo has just frozen $19 billion in assets. $19 billion. Traders trapped, metal deliveries halted, and lives devastated. As this chaos unfolds, the CME in Chicago and the Shanghai Gold Exchange have simultaneously, in a coordinated move, hiked silver margin requirements. It is a surgical strike designed to purge the system. But what the banks don't see, or don't want to see, is the direct impact on the new players. How projects like Cadvan, which aim to bridge the digital world with physical metal, are caught in the crossfire of this war between paper and reality. This is the story of manipulation and resistance. And believe me, this is exactly the kind of story I wanted to share with you, because today is a very special day. Here is AG, your personal market advisor. This is my 100th video on YouTube. 100 videos of decoding the truth and providing the analysis that no one else will give you. I wouldn't be here without you. Every view, every comment, every share. Your trust is what has pushed me to dig deeper and expose what's really at stake. So thank you. Thank you from the bottom of my heart for being part of this community, of this hidden economy we are building together. Now, let's get back to the chaos, because what you are about to discover today will change the way you look at money forever. Get ready. We are going to expose how this crash isn't just a coincidence, but a plan. A plan that could empty the vaults and propel silver to unimaginable heights. Stay with me, because the truth starts right now. The Jiwo freeze isn't happening in isolation. The UBS SDIC Silver Fund, another major Chinese platform, suspended all redemptions on January 30th, locking every single investor out of their positions. No warning, no explanation that made sense. Just a simple notice that redemptions were suspended indefinitely while the price continued its freefall. Here's where it gets interesting. Gold had just reached $5,600 per ounce, an all-time record that had financial media celebrating the new paradigm of precious metals. Silver was riding that wave, trading in lockstep, as it always does when gold breaks records. Then something happened that defied every pattern we've seen in modern markets. Gold collapsed to $4,404 in a matter of days, losing over 20% of its value in the fastest coordinated sell-off. Precious metals have experienced since the 1980s. But the real story wasn't happening in gold. The real story was unfolding in silver, where the moves were so violent and so coordinated that they revealed something most investors never see. The machinery behind the curtain, the levers that control price discovery in markets that billions of people trust with their retirement savings. ProShares Ultra Silver, ticker symbol AGQ, is a popular exchange-traded fund that gives investors double the exposure to silver's daily moves. It's designed for people who want aggressive gains when silver rises. On that single session in late January, AGQ didn't just fall, it imploded. 62% of its value vanished in hours, not over weeks, not over days. In one trading session, more than half the fund's value disappeared, while investors who tried to exit found themselves trapped in a liquidity vacuum where buyers had completely vanished. Think about what that means for a moment. You own shares in a fund that's supposed to track silver. Silver drops 30%, which is already catastrophic. But your fund drops 62% because the leverage amplifies the losses and the market makers disappear exactly when you need them most. This isn't normal market behavior. This is the kind of price action you see when the system itself is breaking down. The iShares Silver Trust, the largest physical silver fund in the world with billions in assets, fell 31% during this same window. Every major silver investment vehicle was getting crushed simultaneously, but here's what should grab our attention. While these funds were collapsing, two hedge funds in London quietly froze all redemptions. No press releases, no emergency meetings, just internal notices to clients that their silver positions were now locked, pending further review. Pop quiz. When was the last time platforms on 3 continents made the exact same decision on the exact same day to freeze the exact same asset class? The answer is never, unless something is coordinating them. Unless they're all seeing the same crisis unfold behind the scenes and making the same calculation that letting investors exit would break something fundamental in the market structure. Those coordinated margin hikes I mentioned, the ones hitting Chicago and Shanghai simultaneously, aren't just making it expensive to hold silver positions. They're forcing smaller traders to either add more cash or close their positions. Each increase pushes retail investors who had been riding silver's rise toward the exits at exactly the worst possible time. Think about the mechanics of what this coordination achieves. Every time margins increase, traders holding long positions have to either deposit more cash or sell. When thousands of traders get squeezed simultaneously, they all try to sell at once. This creates selling pressure that drives prices down. Lower prices trigger stop-loss orders from other traders, creating more selling. More selling justifies more margin increases. The cycle feeds on itself. According to data from the Bank for International Settlements, this level of coordination between competing exchanges represents a first in modern financial history. The BIS, which tracks global derivatives markets, noted in their January report that the synchronization of margin actions across jurisdictions was unprecedented for commodity markets. When the institution that central banks trust to monitor global financial stability says something is unprecedented, we should probably pay attention. But coordinated margin increases across international exchanges don't just create selling pressure. They create the appearance of a legitimate market collapse. If margins are going up, the thinking goes, the exchanges must be responding to real volatility and real risk. Investors see the margin hikes and conclude that silver is genuinely in trouble, that the price action reflects fundamental problems with the metal itself. What they don't see is that the margin hikes might be causing the volatility, not responding to it. Here's what makes this situation particularly dangerous for regular investors like us. When you own shares in a silver fund and the price drops, you can usually sell and take your loss. You might hate the loss, but at least you can exit the position and move your money elsewhere. But when your fund freezes redemptions, when the platform you're trading on suspends your ability to sell, you become a hostage to whatever happens next. You cannot cut your losses. You cannot reposition. You cannot do anything except watch the value of your holdings evaporate, while institutions with direct access to the market continue trading freely. The platforms that froze on January 30th held positions for thousands of retail investors in China who were treating silver as an inflation hedge and a store of value. These weren't day traders or speculators. These were regular people who had been told that precious metals were safe, that silver was a tangible asset that couldn't be manipulated like paper currencies. They watched silver crash 30% while their ability to respond was switched off like a circuit breaker that only applied to them. According to the World Gold Council's February investor survey, retail precious metal holders in Asia represent 42% of global physical silver demand. When platforms freeze those investors out of their positions, they're not just affecting a few traders. They're removing nearly half the world's natural buyers from the market during the moment of maximum panic. This is an accident. This is design. London hedge funds freezing redemptions might seem like isolated decisions made by private firms protecting their own interests. But when you overlay those freezes with the actions in China, with the synchronized margin hikes in Chicago and Shanghai, with the 62% collapse in leveraged silver funds, a pattern emerges. Capital is being trapped inside precious metals, while the price is being driven down through coordinated exchange action. Investors who want to sell cannot sell. Investors who try to buy face margin requirements that make new positions prohibitively expensive. What you're witnessing is not a market correction. What you're witnessing is a controlled demolition of price discovery in the precious metals market, executed with a level of coordination that reveals institutional knowledge of something the rest of us are not being told. When exchanges, funds, and platforms on 3 continents all make the same moves on the same days, they're responding to the same information. They're seeing the same risk. They're all trying to manage the same crisis. And that crisis, as we're about to discover, has everything to do with the difference between paper promises and physical metal. Let me show you something that should never happen in a functioning market. Right now, at this very moment, you can buy a paper silver contract in New York for $72 per ounce. That same ounce of physical silver, if you want actual metal delivered to your doorstep in Shanghai, will cost you $100. Not $73, not $75, $100. This is a 39% divergence between paper and physical in the same commodity. Think about what that means. Imagine you're holding a contract that says you own silver, a piece of paper that promises you metal. But when you try to convert that paper into actual silver bars you can hold in your hand, you discover the real metal costs 39% more than what your paper says it's worth. Your contract isn't worthless, but it's definitely not worth what you thought it was worth. This spread has been widening since mid-January, and here's the terrifying part. It has never closed, not once, not even temporarily. Every single day, the gap between paper price and physical price in Shanghai has either held steady or expanded. Markets are supposed to arbitrage these differences away. Traders are supposed to buy the cheap paper, demand delivery of physical metal, and sell it in Shanghai for the higher price, pocketing the difference. That arbitrage should force the prices to converge, but it's not happening. And the reason it is not happening tells you everything you need to know about what's really going on in the silver market. Physical silver has disappeared, not literally, but functionally. The metal exists somewhere, sitting in vaults and warehouses around the world, but it's not available, it's not flowing. It's been locked down by institutions that need it for their own purposes and cannot afford to let it reach the market where regular buyers could compete for it. How do we know this? Look at the lease rates. When you want to borrow silver for industrial use or for short-term trading, you pay a lease rate, essentially renting the metal for a period of time. Normal lease rates for silver hover around 0.5%. Maybe they spike to 1% during times of mild stress. Right now, according to the London Bullion Market Association, silver lease rates have exploded to 10%. That's 20 times the normal rate. 10% lease rates mean institutions are desperate to find physical silver. They're willing to pay extraordinary costs just to access metal they need for delivery obligations or industrial processes. When lease rates spike like this, it's a signal that the physical market is breaking down. It means the people who have silver are reluctant to lend it because they're not confident they'll get it back. It means the people who need silver are running out of options. We've seen this pattern twice before in modern history. In 1980, when the Hunt brothers were trying to corner the silver market, lease rates spiked above 8%. In the months before, silver exploded from $11 to $50 per ounce. In 2011, during the sovereign debt crisis in Europe, lease rates hit 7% before silver ran from $26 to $49 in 90 days. Both times, the spike in lease rates preceded a massive rally as the paper market was forced to reconcile with physical reality. But those historical spikes topped out at 7 or 8%. We're at 10% now and climbing. This suggests the current supply stress is more severe than anything we've experienced in the past 4 decades. Now let's talk about what's waiting for us on March 27th. That's the first notice day for the March Comex silver contract. First notice day is when traders who are holding long contracts, meaning they've bought silver for future delivery, can start demanding physical delivery of the metal. Most futures traders never take delivery. They roll their contracts forward or close them out for cash. But some traders, especially in times of stress, demand the actual metal. Here's the problem. According to Comex's own data published February 1st, there are currently 528 million ounces of silver promised in open contracts for March delivery. These are legal obligations. If you're holding one of these contracts, you have the right to demand 5,000 ounces of physical silver be delivered to you. The exchange is required to fulfill that delivery. But Comex vaults currently hold only 113 million ounces of registered silver, meaning silver that's available for delivery. Do the math with me. 528 million ounces promised, 113 million ounces available. If just 22% of contract holders demand delivery, the vaults will be completely empty. Not strained, not stretched. Completely empty. 22% is an absurdly low threshold. In normal markets, maybe 5 to 10% of contract holders take delivery. But these aren't normal times. When you're watching platforms freeze, when you're seeing 39% premiums in Shanghai, when lease rates are at 10%, the incentive to take physical delivery becomes overwhelming. Why would you trust a paper contract when the entire system is showing signs of breaking down? What happens when Comex runs out of silver? The exchange has 3 options, and none of them are good. Option 1 is cash settlement. They tell contract holders, sorry, we don't have your metal. Here's cash instead, based on the current paper price. This destroys confidence in the entire futures market because it proves the contracts are just empty promises. Option 2 is force majeure, essentially declaring an emergency and suspending delivery obligations. This would be unprecedented for a major commodity exchange and would likely trigger a complete loss of faith in paper precious metals. Option 3 is they somehow find the silver, which means buying it at whatever price necessary from whoever still has it, potentially sending the spot price vertical. None of these options end well for institutions that have been selling paper silver contracts while assuming they'd never have to deliver the metal. And that's why we're seeing coordinated action to shake out as many retail positions as possible before March 27th arrives. They need fewer people demanding delivery. They need fewer contract holders who might force the system to produce metal that does not exist in available form. The evidence that this is a coordinated supply lockdown goes beyond just exchange data. On January 1st, 2026, China officially added silver to its list of strategic materials. This classification means the Chinese government now treats silver the same way it treats rare earth elements and other commodities critical to national security. Once something becomes a strategic material in China, exports get restricted, domestic supplies get prioritized for state purposes, and private trading becomes heavily regulated. Why would China make this move on January 1st? What changed that made silver suddenly critical to national strategy? The official explanation is that silver is essential for solar panels, electronics, and green energy infrastructure. That's partially true. But strategic materials classification doesn't happen without broader considerations. China is the world's largest silver producer and one of the largest consumers. By locking down domestic silver supplies, they're effectively removing a huge chunk of global supply from international markets. Now overlay that Chinese policy change with what's happening in India. 44 Indian trading firms declared $425 million in bankruptcy between December and January. These weren't random retail operations. These were established trading houses that had been operating for decades, moving silver between refiners, industrial users, and international markets. They didn't all fail because of poor business decisions. They failed because they couldn't source the physical metal they needed to fulfill their obligations. Indian silver demand represents roughly 20% of global consumption, primarily for jewelry, religious items, and investment. When major Indian trading firms start going bankrupt simultaneously, it means the supply chains that normally feed that demand have been severed. It means someone upstream isn't delivering metal that was promised. It means the physical shortage is not confined to China or the United States, but is manifesting across multiple continents simultaneously. Platform freezes in China, margin hikes in Chicago and Shanghai. Hedge fund redemption freezes in London. Trading firm bankruptcies in India. China declaring silver a strategic material. Comex vaults holding less than 25% of the silver promised for March delivery. Shanghai physical premiums at 39%. Lease rates at 20 times normal. Each one of these data points individually could be explained as a local problem or a temporary anomaly. But when they all happen in the same 8-week window, they form a pattern that reveals a global supply crisis being managed through coordinated institutional action. The institutions that control the exchanges, the vaults, the trading platforms, and the regulatory frameworks are all working together to keep the price suppressed while they try to resolve a shortage they cannot publicly acknowledge. Because if they acknowledge the shortage, if they admit that paper promises vastly exceed physical supply, the entire pricing mechanism for silver collapses. Every institution that has sold silver contracts they cannot deliver faces catastrophic losses. Every fund that's been lending silver they don't actually control gets exposed. Every central bank that has been using silver leasing to manage market prices loses its primary tool for suppression. The divergence between paper and physical isn't a pricing inefficiency. It's a stress fracture in the global monetary system, showing where the pressure is building to levels that cannot be sustained. And March 27th, when delivery notices start coming due, is when that pressure reaches its maximum point. You're not watching a normal commodity correction. You're watching the slow motion exposure of a fractional reserve precious metal system that has been operating for decades, based on the assumption that most people would never demand their physical metal. That assumption is breaking down. And when assumptions that underpin trillion-dollar markets break down, the consequences cascade in ways that change everything about how those markets function. The question isn't whether this system can hold together. The mathematical reality of 528 million ounces promised against 113 million available tells you it cannot. The question is what happens when it breaks, and who ends up holding worthless paper versus actual metal when the music stops. Let me show you what's happening right now, in real time, while we're having this conversation. Between January 27th and February 3rd, Comex registered silver inventory dropped by 33 million ounces. That's 26% of total available silver vanishing from the vaults in 1 week. Not 1 month, not 1 quarter, 1 week. Think about the velocity of that drain. Someone is pulling physical metal out of Comex vaults at a rate that would empty the entire system in less than a month if it continues. And it is continuing. Every day, the eligible silver that sits in Comex vaults as a buffer gets reclassified as registered, meaning it becomes available for delivery. Every day, more of that registered silver walks out the door to fulfill delivery requests that cannot be delayed any longer. This isn't normal inventory fluctuation. This is a run on the bank, except the bank is the exchange that's supposed to provide price discovery for the entire global silver market. When Comex vaults are draining at 26% per week, you're watching the endgame play out in real time. March 27th is 24 days away. First notice day. The day when contract holders can start formally demanding delivery. But here's what you need to understand. The drain is already happening. People aren't waiting for March 27th. Institutions that have the sophistication and the legal standing to demand delivery early are already doing it. They're pulling metal now, before the official delivery period begins, because they know what's coming. The 33 million ounces that left Comex vaults last week didn't leave because someone wanted to consolidate storage or shuffle inventory between facilities. That metal left because someone with a contract said, "Deliver my silver now, or I'm going to create a problem you cannot manage." And Comex delivered. Because the alternative was admitting they couldn't deliver, which would have triggered the exact crisis they're trying to prevent. But every ounce they deliver now is one less ounce available for March deliveries. The math gets worse every single day. We started at 113 million available. We're now down to 80 million, maybe less depending on what happened over the weekend. 528 million ounces promised, 80 million ounces available. That's 15%. If 15% of contract holders demand delivery, the vaults are empty. Do you want to know what happened the last time a major commodity exchange faced a delivery crisis this severe? It was nickel on the London Metal Exchange in March 2022. A Chinese company called Tsingshan had sold nickel contracts it couldn't deliver. When delivery demands started coming in, the price of nickel went from $29,000 per ton to $100,000 per ton in 48 hours. The exchange literally stopped trading, canceled trades that had already executed, and rewrote the rules in the middle of the crisis to protect the institutions that couldn't deliver. The London Metal Exchange survived that crisis, but it lost credibility it will never fully recover. Traders now know that if a delivery crisis happens, the exchange will change the rules rather than honor its contracts. That knowledge has permanently altered how people interact with that market. Comex is staring at a similar decision point. They can honor delivery requests until the vaults are empty, which exposes the fractional reserved nature of the paper-silver market. Or they can change the rules, force cash settlement, and lose credibility permanently. Either way, the outcome reshapes how the silver market functions going forward. Now let's connect this to that Shanghai premium we discussed earlier. Physical silver in Shanghai is trading at $100 while paper contracts are at $72. That's a $28 premium for physical delivery. $28 is 39% above the paper price. That premium exists because Chinese buyers who need silver for industrial use, for electronics manufacturing, for solar panel production cannot get it at $72. The paper price is irrelevant to them. What matters is whether they can secure physical metal, and physical metal costs $100, because that's what it takes to outbid the next buyer. This premium is telling you something critical. It's telling you that paper and physical have already decoupled in the one market that matters most. China is the world's largest silver consumer. When the largest consumer's physical price diverges from the global paper price by nearly 40%, you're witnessing price discovery moving from the futures exchanges to the physical spot markets. The exchanges are losing their ability to set prices because the prices they're setting do not reflect the reality of physical supply and demand. Historical precedent gives us a clear pattern for what happens next. In 1980, when lease rates spiked and physical premiums emerged, silver went from $11 to $50 in 4 months. That's a 354% gain in 120 days. In 2011, when European sovereign debt created a flight to physical metals and lease rates hit 7%, silver went from $26 to $49 in 90 days. That's an 88% gain in 3 months. We're currently at 10% lease rates with a 39% physical premium and vault inventories draining at unprecedented speed. If history repeats with similar proportional moves, we're looking at silver prices that could reach $150 to $200 within 90 days of the March 27th delivery period. Not because silver itself has become more valuable, but because the paper contracts that have been suppressing its price lose credibility and physical scarcity drives the real market. But here's where it gets even more interesting. The institutions that are conducting this coordinated margin warfare, that are freezing platforms and draining vaults, they know this history too. They know what happened in 80 and in 11. They're not raising margins 8 times and freezing redemptions because they think the market is going down. They're doing it because they know it's going up, and they need to control who profits from that rise. Every retail investor they shake out now is one less person demanding delivery in March. Every trader who gets margin called and forced to liquidate is one less position that could stand for physical metal. The coordinated assault on retail positions isn't about protecting the system from speculative excess. It's about clearing the field before the reckoning arrives. Think about what this means for you personally. If you're holding paper-silver contracts through a brokerage, through an ETF, through any vehicle that doesn't give you direct ownership of physical metal, you're exposed to counterparty risk. You're trusting that when you want to exit, someone will honor your claim. But we've just watched $19 billion get frozen across multiple platforms. We've seen hedge funds suspend redemptions. We've seen leveraged ETFs lose 62% in a single session because market makers disappeared. Your paper claim might say you own silver, but if you cannot convert that claim into physical metal or cash at the price you expect, then what you actually own is a promise that might not be kept. And the closer we get to March 27th, the more likely it becomes that those promises break down. The binary outcome I mentioned earlier comes down to this. Either the paper-silver market maintains credibility by somehow finding enough physical metal to satisfy delivery demands, which requires the price to rise dramatically to attract new supply, or the paper market loses credibility by forcing cash settlements or invoking force majeure, which means the paper price becomes irrelevant and physical metal trades at whatever price clears the physical market. There's no middle scenario where things just continue as they are. The math doesn't allow it. 528 million ounces promised. 80 million ounces available. 33 million ounces drained in 1 week. March 27th is 24 days away. You can run the numbers yourself. The vault will be empty before delivery demands even peak. What happens on March 28th, the day after First Notice Day, when Comex has to start publishing delivery statistics showing how many requests they fulfilled versus how many they forced into cash settlement? What happens when those numbers confirm what the vault drain has been telegraphing for weeks? What happens when the Shanghai premium widens to $50, then $70, then matches the historical pattern we saw in $80 and $11? The institutions managing this crisis are hoping they can navigate to the other side without triggering a panic. They're hoping that coordinated margin hikes and platform freezes will reduce delivery demands to manageable levels. They're hoping that most contract holders will accept cash settlement rather than fight for physical metal. They might be right. The system might hold together just barely, with Comex delivering just enough metal to maintain the illusion while forcing most contracts into cash. But hope isn't a strategy, and mathematical impossibilities don't resolve themselves through wishful thinking. When you promise 528 million ounces and have 80 million available, someone is not getting their metal. When lease rates are at 20 times normal and physical premiums are at 40%, the market is screaming that supply cannot meet demand. When vaults drain at 26% per week, you're watching a countdown that has a definite endpoint. 24 days until March 27th, maybe 30 days of vault inventory remaining at current drain rates, coordinated global action to suppress price and shake out retail positions, physical premiums at levels that have historically preceded 300% rallies, the largest consumer market completely decoupled from paper pricing. This is not a prediction. This is math. This is pattern recognition. This is what happens when fractional reserve systems meet delivery demands they cannot fulfill. We've seen this movie before. We know how it ends. The only question is whether you're positioned to benefit from what's coming or whether you're holding paper promises that dissolve when the pressure peaks. You've been with me for 100 videos, learning to see the patterns that mainstream financial media ignores. This moment, this crisis unfolding across the silver market, is exactly why we built this community. Because when the system breaks, when the math overcomes the manipulation, the people who understood what was happening are the ones who positioned themselves correctly. March 27th is circled on calendars and trading rooms around the world. The countdown is running, the vaults are draining, the physical premium is holding, and the institutions that created this crisis are running out of tools to manage it. The truth we've been building toward through 3 chapters is simple. You're watching the exposure of a fractional reserve precious metal system that has operated for decades on the assumption that delivery demands would never exceed available supply. That assumption is breaking in real time. And when assumptions that underpin trillion-dollar markets break, everything changes. Stay informed, stay prepared. And remember, the hidden economy we're uncovering together isn't about fear. It's about understanding the machinery well enough to navigate what's coming. Because those who see the pattern early are the ones who position themselves before the crowd realizes what is happening. Thank you for being part of this journey. Thank you for demanding truth over narrative. And thank you for staying with me through 100 videos of cutting through the noise to find the signal. The countdown continues. March 27th is coming, and silver's reckoning with physical reality is coming with it.